1/1/2012. Who are we looking at? Goldman Sachs, February 12th, $100 call that Goldman Sachs is going to report earnings in January. This is January, and they're going to report earnings, I believe, on the 18th. Is that it, everyone? And the monthly options expiration expires on the 20th, and the calls have been marked down. And I'm going to set alarms, falls to $1.20, down to 75 cents. But they're deflated in value of the $100 call. And what I am going to do here is I'm going to go through with MMTs at Goldman Sachs. We're going to go to the $90 call that expires, and we're going to take a look at the markdown of the value of the premium. The premium value, we'll look at the shorter time frame of that premium that we like to buy wholesale. And it's all based on earnings coming in 2012, as it is now 2012 upon us. Happy New Year to everyone. And this is part of understanding one thing for sure, is that we are marked down. These contracts were, right now, Goldman Sachs, the call side is getting marked down to wholesale levels. You can clearly see that this $90 call was up here, $15, $16, $17. And that right now, what we're going to be looking at is what happens with those as far as forward-looking value going into the earnings. And we'll be doing a weekly chart, but I'm going to set alarms right now. Falls to 320, falls to 280, falls to 240, and ultimately we will get down into the 220. I just want to know that there's a bid there that you would have an alarm no matter what at 220. And if we undercut a lot of that, you would mark it down to $1.70. Okay, between now and January 18, 2012. That's on the $90 call right now. When we take a look at some of the put side, we take a look at the $90 put right now on this daily chart. This is the put side of Goldman. And yes, the put side was marked down to a value over here. So basically what we're going to be doing is we're going to map it out clearly. In the current term, that $90 put back here on this daily chart on 12/19 December 2011, the high was 633. They marked the put down to the low here on Goldman to 227 on 12/23. And we currently had a markup cycle, a 3-day markup cycle to 365 on the high on 12/28. And that the $90 put, we would want to set alarms because the low was marked down to 290. So now we can see that that $90 put is being marked down, but the real markdown is that we're going to want to set alarms. The close was $3, so set alarms at 220, set alarms at 250, set alarms at $1.80, and set ultimately alarms at $1.10. Falls too. Okay? Because if they fall down there, then that means that the call side would be going up. So I'm going to cover the $95 put that's in the money. It's $5 in the money. We can clearly see that that high side put over here on 12/19 had a high value of 9.75. Yes, this $95 put when Goldman broke down, and it's at $90 a share, this put option on 12/23 was 420. That was the markdown. We had a 3-day markup to a high of 665 and lows of that 420. So you've got a $2 range in these 3-day periods because Goldman's volatility isn't running extremely high, but we're going to put falls to, they close at 580. We'll put falls to 490, 460, 440, and ultimately 380, 350, and we'll get down below that lower market at $3.20. And that falls too on the $95 put as we go into Goldman Sachs earnings. Weekly chart is that Goldman clearly has a path of support so far ending calendar 2011, because we do. There's the weekly bottom, there's your rally tops, and there's your rallies, and we're right here. And we closed out the calendar year at a weekly support level. We'll be watching Goldman on a daily level. One of the things that we're going to be very coherent of is Goldman extremely overbought? No, on a weekly level, it's not. It's at about 25% in that public figure, and we'll put it into the StockMarketFunding.com system. I just want people to know that Goldman Sachs on this weekly chart, that's one support level. Back in the financial crisis when we were buying Goldman, we had great buying opportunities. If we break this $90 area and this lower weekly support area that goes right over here, we get back into challenging these 2009 where Goldman was here. That's where it was on 3/15 of 2009, was right around $73. It's got support up here on the weekly. There's 80.73. There's 80.64 in here. These are, if we were to break down and challenge that low before going into earnings, we're going to look and see on a daily level. But just remember, when you are in an earnings season and Goldman continues to sell down, because Goldman Sachs is a good gauge of the economy. And when Goldman doesn't do well, then lots of things don't do well. But when Goldman does turn around, then it has a signal, because Goldman is very diversified around the world. And they are. That doesn't mean that Goldman Sachs made the best decisions. I'm not saying that. What I am saying is this is the magnitude of Goldman's positioning around the world, as they got a lot to say in things. But here's what I got to say on this weekly reversal right here. So on the weekly reversal, the shorter term upside resistance will be right here. And that's going to be right around 94.36, right below that 95 weekly handle. That's going to, and here we are on this weekly level. Now we're in 2012, come Tuesday. So this is that level right here, MMTs. We will set alarms on the equity falls too. This concludes January 18th, Bell Leader, Goldman Sachs, and it's been marked down. And these markdowns with Goldman going into calendar 2012, yeah, it's marked down because there was a lot of bearish and lots of things. Who cares about that? It's where the value is. We'll definitely be plugging this into the SMF system. We'll be looking at volume weighted average price, on balance volume, and many other things that we have in our tool set to guide us in this wonderful trade on Goldman Sachs, using the call side, the put side, the marking down of all of the contracts that I had stated. And here it is, it's Goldman Sachs. Once again, look, all eyes, they can run Goldman or sell Goldman down. And here's the $90 put. They've been marked down too. So, and here's the $90 call on a weekly. It's been marked down too. So buying markdowns on both sides of the market is the least amount of dollar risk involved, because you're getting relatively both sides at your discount entry. And that is the key to success.